Welcome to NASDAQ Trade Talks. I'm Jill Malandrino, Global Markets Reporter at NASDAQ. Joining us on the NASDAQ Market Site desk, we have Chris Englebert, Founding Partner and Chief Investment Officer of Englebert Financial Advisers, as well as Maddie Ragnar, Director on NASDAQ's Market Intelligence Desk. We will be bringing in our resident technical analyst, Brian Joyce, Managing Director on NASDAQ's Market Intelligence Desk. It is great to have the both of you with us. Chris, you think perhaps we can get a 5-5-5 here? We'll get into that in just a moment. But let's talk about the big elephant in the room, of course, what's happening with the Fed.
Yes, so there's been a little bit of a shift this week. Of course, we saw a little bit stickier of inflation. So the 6 cuts that were expected at the end of last year are now down to about 2, 1, none. We're still trying to figure that out, but the June cut that was expected is no longer on the table. So that is more looking like September or even maybe down the line.
Right. And Chris, what's so interesting is we saw the move that we got in December when the market was pricing in 6 to 7 rate cuts, ended up hitting all-time highs, despite the fact we didn't get any. Perhaps the market's view is, you know what, companies have been able to navigate this higher interest rate environment. Earnings have been quite decent. Margins haven't been compressed. Maybe the market's moving on fundamentals and not simply just rate cuts. And we're also seeing, you know, the market broadening out a bit here.
Yeah, I mean, there's been this acceleration at the beginning of the year. You know, the whole AI stock bit, really ramped up and drove the markets even higher. One of the encouraging signs, I mean, our risk indicators are elevated at this point in time because I think we've actually stolen some of 2024 returns by booking it in 2023. But the positives is that we're getting a handoff, and we're getting a handoff to the financials and energy stocks, 2 areas that actually will probably have pretty good earnings this year, not decelerating earnings, but potentially accelerating earnings.
Yeah, well, by the way, the other 493 stocks in the S&P 500 outside of the Mag 7, they returned on average 8% in the first quarter. I'll take that, especially if you think about an annualized basis. So it's not like, I mean, it was solely exclusive of what was happening with the Mag 7, certainly influential, but other areas of the market did participate and are starting to participate.
Yeah, I think it's long overdue too. I mean, we've seen just about every area in the Magnificent Seven, or whatever you want to call them, they're finally beginning to see some underperformance. And I really think if you're a pension board trustee or somebody and you're like, hey, we have a lot of money in core equity products, you realize that these core equity products are really extremely valuated from a technology standpoint, and you're like, we're really concentrated, we need to diversify these portfolios, and good consultants are telling pension trustees that you've got to invest in other areas in the market, especially equities.
Right, well, it's not return just one for one. There are mechanics involved with portfolio management, to your point. I want to bring Brian in here for a moment because we are talking about the shift going into financials and energy, but I want to focus on energy for a moment here because the price of oil is also a big part of this narrative. So Brian, if we can bring you in here, take a look at crude and some of the trends that you're seeing within the energy ETF XLE.
Within the energy ETF, so we've had a very nice run, from the beginning of January when we were trading down around $79 in the ETF, and we ran up about 25%, near $100 a share. And so the last week, we peaked actually last Friday, the day before the geopolitical tensions on Saturday took flight. And so we've actually been pulling back during that time. We could see that last week's high, the daily RSI was extremely overbought, hit at 84 level. And we're now pulling back, and yesterday and really the last 3 days this week, we're seeing support bottoming here around this 93 and a half level. And if we zoom out a little bit to the weekly period chart, we could see that was not just a prior high going back to September of last year, but the long-term weekly period chart, we could see that was the top going back to January of 23, again in November of 22, and the initial level when it first hit there was June of 22, which was 3 months after Russia's invasion of Ukraine. So that was kind of maybe a blow-off move at that point in time. We certainly had very strong moves in 2020 and 2021 where we had gains. Well, 21 we have up 46%, in 22 we have 58%, and since been in a long consolidation, which just 2 weeks ago we broke out to the upside from. So this pullback right now is testing those prior highs, which now I expect to act as support. What's interesting is when we've been consolidating for nearly 2 years in this range, this lower panel right here is showing the on-balance volume. And we can see that during this consolidation period, on-balance volume, which is an aggregate of buy volume versus volume on down days, in this case, it's a weekly period. So weeks where the XLE was higher versus lower, the volume has actually been trending higher. So that tells us that the the pullbacks during this 2-year consolidation have been on lower volume, while the gains during this period have been on much higher volume. So this has been making new highs all throughout, and is confirming what was a leading indicator, you could say, to the recent breakout in this ETF. So I think this looks very constructive. Breakouts from these big multi-year ranges tend to have some very good momentum behind them, and I think what we're just seeing in the very near term is just a natural consolidation after this strong gain of 25% this year.
All right, Brian, we'll be back to you in just a moment to go over rates. Chris, what do you mean by we could have a 5.5 year?
Yeah, so coming into this year, we were looking at the different asset classes and what the returns are. And when you shoot out and say, okay, where are earnings and interest rates the next 12 to 24 months, I come up with the S&P 500 could do 5%. Now that's the S&P. I do believe there are other areas, i.e. small mid caps, that could do better than that. But then you have bonds do 5%, maybe lower rates or a hint of recession going into 25. And then you have commodities do 5%. To Brian's point, I mean, we've already seen some of the commodity ETFs are up low double digits at this point. And then you've got cash at 5%. So finally, investors have an alternative where they're getting paid to sit in cash to wait to see what's going to happen. And again, with the volatility in the market, and the market's going one way, you're getting paid from a valuation standpoint to sit in cash and wait and see what happens. Now, obviously, from a financial planning standpoint, long term, you don't want to be sitting in cash, but there are periods of time that cash is king, and we think that's the area right now.
Right, and Maddie, Chris had brought up small caps before. They've still yet to participate.
Yeah, we are seeing a bit of a consolidation, especially this week and in April. Since November of last year, small caps, Russell 2000 microcap and S&P small cap were up double digits, which was extremely exciting. But in April, they are down about 4, 5, 6%, those small cap focused indices. So hopefully this is, as Brian mentioned, more of a near term projection, and they will start to take off a little bit, especially as they're planning their next quarters.
Yeah, well, I mean, is it just because we know we're going to be in a higher interest rate environment, or are there operational concerns in certain sectors within the small caps?
Yeah, I focus a lot on our healthcare small cap listings, so cash runway is a huge focus right now. Last year we saw about 170 restructurings within the biotech space, specifically companies who don't have a positive cash return, which is up from 115 in 2022. So it will be interesting to see if we continue to see that projection, if more companies are going to restructure as they're looking at higher rates for longer.
Of course, let's talk about the S&P 500 for a moment here. Would you say valuations are still high?
Yeah, I mean, we've looked at a couple of different measures. I mean, one of them is that when you look at the dividend yield on the S&P 500 from a historical level, it's never been lower. Now, obviously, back during the 2008 global financial crisis, the dividend yield was 3.5%. It was a great time. During COVID, it got back to almost 3.5%. But again, now some people, when they use this indicator from a valuation standpoint, and I always caution people that when you use valuation indicators, it's not a timing indicator. It's not saying, hey, we hit these extreme valuations now, sell everything. What it's telling you is that you got to be cautious at this point in time because you've got super low dividend yields off of the S&P 500. Same thing goes with when you look at forward price earnings or PEs compared to the 10-year Treasury. So again, as the 10-year Treasury ratchets up, that is making the S&P 500 on a forward earnings look even more expensive. So again, when you look at the whole landscape, and if I wasn't a financial consultant, I'd be a bookie. But when I say that, I'm saying I'm looking where the risk is out there. And right now, the risk is in the U.S. equity markets focused technology S&P 500, why there's very low risk in the bond market, even though rates have gone up, but more specifically in cash at this point in time.
Yeah, I mean, if you think about it, when you look at the yield curve, we're talking about that it's inverting, it signals a recession. Well, that hasn't materialized. And you noted here that perhaps the Fed is signaling to investors that cash is king.
Right. I mean, the Fed is trying to walk this, real tightrope, like, hey, when do they lower rates, and is that going to ignite the rally? And continued rally in the markets. I'm like, you got to be a little concerned. If the Fed is beginning to lower rates aggressively, it may not be for the right reasons. It may be because the economy is slowing down. So again, this inverted yield curve, the pundits have been yelling for almost 2 years that it's going to have a recession. Well, hey, a stopped clock is right twice a day. You know, eventually we're going to have a recession, and maybe they're right. But again, our elevated yields, that seems to be the tool that the Fed keeps going back to, and they're telling us, hey, they're going to be higher for longer, much like you said.
Yeah. All right. Well, let's bring Brian back here, and let's take a look from a technical perspective what the 10-year is signaling, Brian.
The 10-year yield. Okay, so we're looking right now. Last week on Wednesday, CPI April 10th came out, and that was the big break from an 8.5-week resistance level that had been in place since middle of February. That was 4.34%. And it's just been trending higher since. We zoom out, we can see that 4.34%. Its importance goes back to the high made in October of 22. We had a pullback for about 11 months, consolidated below there for then another 3 or 4 weeks, broke out to last year's high in September, let's say late October 23, up around 5.02%. So we've now have 3 strong weeks higher to the upside. This week's high is 4.7%, and trying to call a top here, I think is difficult. Obviously would be, I think, data dependent. One factor at least, and then maybe if we see moves up from here, I think an obvious expected level would just be last year's prior high, up around 5.02%, and then see what happens from there.
Yeah. Well, let's talk about some of the narratives that we're focusing on right now, right? Just about, let's call it 12 to 13% S&P 500 companies. They reported earnings, relatively positive season. We see a little bit of volatility in the market this week. What was Monday, April 15th? There's going to be some tax selling there, particularly if you had a stock like NVIDIA as one of your holdings.
Right. Yeah. And again, you've got extended gains in these stocks. One of the things that we were doing is that as our risk indicators got elevated in January and February, we were starting to sell some of these extended AI stocks, like Broadcom. And it got to the point where you almost had to tranche in your sales, like I'm selling at 1,000, 1,100, 1,400, because again, the risk is elevated there. There's going to be some capital gains, unfortunately, for this year, which is good. It's always better to take capital gains and capital losses. But again, I still think the overriding theme is that investors the rest of the year are going to be looking at other areas in the stock market to make money. And they're going to focus on, I still think, small mid-cap stocks. Now, you talked about the biotech area. One of the things I think is going to finally ignite the small mid-cap area is takeovers. How many takeovers have there been this year and last year in the biotech area? I think in other areas in the small mid-cap, you're going to see some continued takeovers because it's a lot less expensive for a company to buy another company than it is to build a company from scratch. And we haven't seen that since the 1980s. When that takeover fever hits, all of a sudden that small mid-cap area ignites off. And again, I still think the S&P does around 5% this year, but this could be the year small mid-caps do 3, 4, 5, 6 times that.
Yeah, Maddie, anything discernible in earnings that you've picked up so far? I mean, granted, it's a little bit early in the season.
Yeah, it's a little early in the healthcare space at least, but it is predicted that certain value sectors are going to see a better performance in earnings this year. So utilities, financials, healthcare, that will be interesting though, based on the higher rate environment, if that will stay true. So we're kind of waiting it out and seeing how that will go.
It sounds like you're aligned with Chris here for sure.
Yeah.
All right, Brian, let's bring you back in one more time. Let's take a look at the S&P 500. As we've been discussing over the past couple of weeks, it seems as if not just the S&P 500, but other major averages have been at pretty key inflection points and spots on the chart here.
Yeah, I'm not sure if the S&P is there yet. In my opinion, very near term, we do have this price gap that goes back to late February. It's a 1% range. The bottom of the gap is 49.83. We're very close to that right now. So I would think that could be a minor support where potentially you could see a bottom in this pullback. But if I zoom out longer term, we could see that this was just a phenomenal move from that 5-month stretch from November through the end of March, and here we are in April now with this 3-week pullback. Wouldn't surprise me if we were to say retest that prior high from the prior cycle in 2021, which is right around 4,800. That would only be about another 4% down from here. And if that were to give out, then my next expected level would probably be down around the 4,600 level, which from there would only be another 4%. So another 4 to 8% to the downside. I think that bigger downside possibility is more extreme. Not my first expectation. I think more likely in the a safer call would be maybe potentially down to 4,800. But again, that in the near term, I am focused on this price gap right around here, 49.83, 5,000, just about there right now. So obviously, again, data dependent, so we'll see what drives the narrative.
All right, appreciate the insight as always, Brian. Thanks for joining us this week. Chris, let's wrap it up. April, of course, is Financial Literacy Month, so I'm going to pick your brain a bit here. We know the consumer is strong because if you really want to be employed, you kind of have a job.
Right.
Employment remains strong. But what about this transition of wealth? This seems to be a really big topic when we're talking to advisors.
Yeah, and I'm glad you brought that up, Jill, because we're seeing that. So a lot of the market pundits are out there and they're like, hey, can the consumer continue and be reignited, et cetera? And they never talk about this transference of wealth that's going on. We're on the ground in our shop every day, and we're averaging at least somebody dying, unfortunately, on a monthly basis. The adult children come in, and they're getting some substantial wealth transferred to them, which obviously is a bad circumstance how they're getting it, but the good circumstance is it's helping them, do things that they maybe not be able to do, pay for college, et cetera. And again, I see nothing in the media where people are talking about this, and it's only accelerating, literally in the last 2 years, and it's going to continue going forward. But the problem that we see when people get wealth is that they don't really have any kind of game plan on what they should be doing next. And I spoke about this a little bit before. One of the problems that we're seeing is people are getting inherited IRAs. I just met with a couple and the husband's going to get a substantial inherited IRA. Well, you've got to take that money out over 10 years. He's still working, and that's going to be a tremendous tax burden from the standpoint that he's taking that RMD distribution, paying the tax on it while he's still making a substantial amount of money. So again, I keep telling people, have conversations with your parents about what you're doing. And then if, obviously before the event happens, but if you can't and you get that, you're going to have to sit down with somebody that knows financial planning, can give you some strategy. I think I want to give a shout out to our client services assistant, Tyler. He's worked for us for 3 years now. And I asked him what was the biggest thing that he's learned in the last 3 years. And he said, the biggest thing that I've learned is how little people know about their retirement plans, their IRAs, their 401ks, 457s, 403bs.
That's why we have you.
And how little they've learned about it and how they don't use effective strategies. So for example, if somebody has an inherited IRA that they got to take an RMD from, well, you should be jacking up your contributions to your 401k. And a lot of people just don't follow through with the strategy. And it's something that I think as an industry, we really need to pound home more.
Well, Chris, it's interesting, for Financial Literacy Month, that's a key topic that we've been covering, whether you win the lottery, whether you have an inheritance. Just because you can spend money doesn't mean you should, right? There's other factors. For example, let's say you can afford to spend $1 million on a home. Do you necessarily want to spend that whole nut? Or do you want to think about the bigger the home, the more expensive utilities, landscaping, cleaning services, and so forth? Even before you think about tax implications, just being able to simply budget and be practical about it is important.
Oh, I call it the burn ratio or burn factor. And I draw a chart all the time. I'm like, you've got $1 million. Nowadays, well, you can get 5%. So it used to be the old spending policy was 4%. Okay, 4%, your line is still going to bend up. But if you start spending 6, 8, 9, 10, 15%, of whatever you've inherited or won in the lottery, your burn ratio dramatically increases. And again, to your point, you buy that $1 million house, 10 years from now, you can't afford the upkeep and maintenance, you may be selling that $1 million house. So again, it's stunning sometimes when people, go through this. We see this obviously with professional athletes too.
We do. Sidebar conversation on that one. All right, appreciate the insight as always, guys. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at NASDAQ.